Hello, and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Economic Update, Where We Are in the Business Cycle, featuring Steve Scranton of Washington Trust Bank. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Okay, this is the second session of our virtual 2022 Building Opportunity Conference. Over the span of this conference, we will cover trends and opportunities shaping the built world. More information about our conference and sessions are available in the links provided in your console, as well as on mossadams.com. And now I will hand it off to today's presenter, Steve Scranton, Chief Investment Officer and Economist at Washington Trust Bank. Steve?
Hello, everybody. Thank you for joining us again. My name, as Amy has said, is Steve Scranton. I am the Chief Investment Officer and Economist for Washington Trust Bank. Been with Washington Trust Bank for 33 years, and I've been in the financial services industry for 43 years. So I have seen a few of these economic cycles, and the goal of today's session is to provide you with perspective and information to help you in your planning as you're looking forward over the next 12 months or so. And so let's go ahead and get started here. I think it's always nice to start it off with our first polling question. Since the title of this session is Where Are We in the Business Cycle? I want to hear from you first. So the first polling question, if we could bring that up, Amy, where do you think we are in the business cycle? Do you think we're at the beginning of an expansionary phase? Do you think we're mid-cycle? Do you think we're at the end of a business cycle? Or do you think we're actually in a recession right now? And while you're answering those questions, just a few housekeeping items to let you know. We're going to take questions via the question and answer box. You can submit those questions throughout the presentation. You can forget your college training of waiting for the lecturer to finish speaking before asking questions. So please feel free, submit them in there. I'm going to pause each time we have a polling question. I will answer questions at that time as well. So I encourage you to submit those questions as they come to your mind and not wait until we get to the end. That way we'll just have a steady stream of questions as we go on with the presentation. So I'll wait for Amy to tell me when we've got the majority of the respondents who've answered. I think it's always a interesting time to try and think, where are we in the business cycle? And I've always told people that that is unique to each person or business. And that's why I like to get the real life perspective of people in the real world rather than economic theory from a bunch of economists. Okay, it looks like from the polling results that almost half of you think that we're already in a recession. The other biggest percentage is thinking that we're near the end of the cycle or heading towards a recession. So very interesting feedback. I'm going to give you my perspective now, which may or may not agree with your perspective, but that's the beauty of being able to have open discussions, is to get multiple ideas and feedback and help us all think about what we think as a situation, whether we need to reevaluate that or whether we're still comfortable with our thoughts that way. So let's go through the question from my standpoint. Are we currently in a recession? And I'm going to go through these slides fairly quickly because the more important thing I'm trying to show you is that even though your economics classes in college and everything taught you that 2 consecutive quarters of negative GDP growth constitutes a recession, that is not true. That was basically taught that way because that's a simple way to think of things. We've actually had times where the economy had 2 consecutive quarters of negative growth, did not have a recession. We've had times where the economy only had 1 quarter of negative growth, had a recession. And we've actually had a couple times where we never saw negative GDP growth before the recession was actually declared. And I think it's necessary to understand that there is an independent body that determines when recessions begin or end. So it isn't the media who decides, it isn't professors, it isn't each of us. And they look at 8 different factors. And what they basically say, the major thing they're saying is it needs to be deep and it needs to be broad. So if it's just one industry that's getting hit by recession, that they don't feel constitutes a recession. And that is the reason why they declared the recession during the pandemic crisis so quickly. It was so deep and it was so broad. Even, we shut down a big part of the service industry, but that rippled through to the rest of the industry. So we had a 2-month recession. That was the first time ever with that. But it was, in that case, we had not had 2 quarters of negative growth before that hit. So I'm going to flip through these indicators real quickly. I'm not really give you an explanation of what the indicators are. I'll talk a little bit more about some of them as I tell you where are we in the current state of the economy. But what we're looking at is it green, is it yellow for caution, or is it red? If the majority of the indicators are red, that would tell me that we are now moving towards a recession. So we have to remember, have a sustained decline, and it needs to cover these 8 sectors. So from the jobs perspective, we've not had a decline in jobs yet. We've seen the pace of jobs growth slow slightly, but jobs still healthy. That's still all go green signal. Same for personal spending. Personal spending dipped down temporarily, and now it's positive again. So we haven't met the criteria with that either. So far, 2 out of the 8 are in green territory. But now we switch and we see that one of the areas that isn't talked about too much by the media is another measure of economic growth called real domestic income. The theory behind this is real gross domestic product measures the sales of products, of goods and services. Real gross domestic income is the income that businesses receive from those sales. Now, in a perfect world, those two should match up. That isn't a perfect world, though, because of different factors going on, which I don't have time to run through for you. But what I'm just trying to tell you, the bottom line is, even though we had 2 negative quarters of gross domestic product, we have not had any negative quarters of gross domestic income yet. So we've got 3 out of the 8 signals saying everything's okay so far, even though it may be slowing. Then if we go on, what we see is that from the employment standpoint, this isn't jobs being created. These are the number of people who say they're employed. We see this has been much more of an erratic up and down, up and down. So I've classified this as cautionary, saying that we don't have sustained growth going on, but we don't have sustained declines either. So we need to watch employment carefully. Same for manufacturing. We're now seeing finally the first time that we've had manufacturing dip slightly into the negative, but that is not a sustained decline. So I think manufacturing, in my view, once again, caution, but not recession yet. And then we look at real personal income. This is income after inflation, and we see the same pattern here. It's just kind of up and down and up and down. So I view that as cautionary again, is that we don't have consistent growth going on in personal income, but we also don't have a consistent decline going on. So then we get into those that actually are flashing red of a recession warning. Manufacturing trade industry sales, it's been negative for a while. It got back to basically break even at one point, and then it's gone negative again. So I would say this one is definitely signaling we're in a recession from their perspective on this section of the economy. And the same for real gross domestic product, which I've already talked about. We see there that we had 2 negative quarters, but really we've had 2 out of the 8 indicators signaling recession. So I'm going to tell you that I believe that the National Bureau of Economic Research, who is that independent body, will not declare recession starting at the end of the second quarter when we had 2 consecutives of negative growth. I think that we have that jury still out as to whether we go into recession. I will talk about that as we go along. But in this case, I am going to have a contrary opinion to almost 50% of you who think that we are in a recession. But I say once again, recession is unique to everybody. So because I say from a national macro perspective, we're not in a recession, that doesn't mean your industry or your business may not be experiencing recessionary conditions. So then let's move on to say, so what is the current state of the U.S. economy? And I think that is trying to help you understand just why I think, again, that we're not in recession. Going back to jobs growth again, what I would tell you there is that, you can see from this graph that we're still creating over 200,000 jobs every month. Before the pandemic crisis, we would have thought these were fabulous numbers because we were having cases of 100,000 or even only double-digit jobs growth before, when we were into 2019, as the economy was starting to slow down. Here, absolutely, I've said we can't maintain 700,000 jobs growth like we did at the beginning of 2021, but we've seen that we've been and touched that level 4 different times during this last 18 months, really. And what we've done is we've slowed, so we're slightly below the 300,000 jobs per month. And I think that's one of the things I look at and say, as many of you who've heard me speak before, my mantra has always been jobs create income. Income is the fuel that consumers use to spend, and consumer spending still makes up over 2/3 of U.S. economic growth. So if we're still creating jobs, that means we're also creating income. So let's look at the second piece then. Let's look at income. What I'm looking at here, though, is I'm looking at income after taxes, after inflation, because to me, that's spendable income. You can't spend this part you have to pay taxes on, and inflation takes away your purchasing power. And even though the graph is, you can't see it real clear at the bottom, it sits basically right from a total amount flat line. It's not falling, it's not growing. It's basically been unchanged for about the last 4 months. And I apologize, I didn't center my graph enough for you to see that clearly. But it's not negative, and I think that's an important thing again, is that one of the things we have to remember is consumers still have savings that they can draw on, even though we've seen 17 consecutive months of real wage growth being slower than real expenses. So people, aren't earning enough to cover the high expenses they've seen. They've been drawing on their savings to create that bridge there, hoping that either the wages go up or the expenses come down. And right now, we've gone from at the peak during all of the fiscal stimulus of March of 2021, where the savings rate was over 20%, we're down to 3.5%. I think that's something we have to pay close attention to, because that gets to a point where pretty soon the consumer, not being the U.S. government, cannot continue to spend once they've used up their savings and their credit cards. So let's look at the next one then and say, so how does spending look? And what we see, this isn't change of spending. The graphs I was giving you before that the National Bureau of Economic Research was looking at was, what is the change month over month? This is the actual level of spending. And you can see spending after the inflation effects. This is real personal spending, which means take away the inflation effects, because if you paid $5 for a gallon of gas a year ago and now you're paying $6, you didn't buy any more gas, but you spent more. So I always look at it after inflation, and you can see it's pretty flat as well. It hasn't turned negative, but it's not robustly growing either. So I think those are the things that I'm looking at, is saying, right now, from a broad perspective, not from an individual business or an individual industry perspective, the economy looks like it's still growing. There were definitely some one-time factors that caused us to have the negative growth in the first 2 quarters. Those are basically unwinding as well. So right now, as of when I put the slide together, the forecast for third quarter GDP growth was between 1.5% to 2.5%. That has now been moved up to closer to 3%, because we just got the August trade balance numbers, and we saw another round of strong exports, and so that's why we've seen that revision upwards. So I think, once again, we're growing, but I'm going to argue that we're barely growing. We're not robustly growing, and I think that that's what we have to keep an eye on, is that this is the reason why I say I don't believe that we're in a recession yet, but that doesn't mean that we might not be heading for one. So let's take a look at our second polling question then. What's your current business strategy? So given your conditions right now, are you looking to expand? Is it business as usual? Are you shifting to a defensive stance? Or are you in the process of executing what I call your economic disaster recovery plan because you're experiencing recessionary types of conditions? And while we're doing that, why don't we switch, Amy, if you see any questions in the Q&A, let's go ahead and tackle those, and then we'll see what the polling results are.
Yeah, so we have quite a few questions coming in. There's been a couple around this topic. Is how much of the recent job growth is recovery of jobs from the pandemic versus new jobs?
I think that what we're seeing there, the U.S. as a whole is ahead of where it was in jobs from February 28th of 2020. So it isn't dramatically ahead. So if I'm saying for the U.S. as a whole, what we have spent up until July was recovering jobs that were lost. But for July and August, we were above the level that we were at February of 2020. So I would say the last 2 months of jobs growth, still in the 200 to 300,000 range, are new jobs being created. There's different stories for different states. I can definitely tell you, at least in the Northwest, for Washington and Oregon, and even looking at some of the Rocky Mountain states in Southern California, they fully recovered jobs a lot sooner than the U.S. did. And so they've seen true jobs creation happening sooner than what the U.S. saw overall.
All right, would you like to get to another question here?
Let's do one more, and let's see what the polling results are, and then we'll save the other ones as we go along, so we still tackle them as we're going along.
All right. What U.S. regions are performing the best? You may have just answered that in your last question, but which regions are performing the best?
I would say, from what we see from the data, it's primarily who's been performing the best has been west of the Rockies. So we've seen strong growth in Idaho, and in Utah, Wyoming, Montana, Washington, Oregon, California. They were seeing fairly consistent, better growth for economic growth before the pandemic. They recovered faster, and they're still seeing economic growth overall stronger. I think some of the weaker areas that we've seen have definitely been in the Midwest, where we've seen more of the traditional blue-collar type of jobs, the Southeast as well. There have been issues down there. And then the Northeast, I think is starting to see good growth as well. But we have a lot of recovery to do in the Northeast with Wall Street, with the Boston area, things like that. So, but from an overall standpoint, west of the Rockies has seen stronger jobs growth than east of the Rockies. So let's go ahead and take a look at our polling results.
Yep. Here we go.
Okay, so we see a pretty even balance again between those that are looking to expand and those that are shifting to defensive. So I think that the good news that I would say is, even though we saw from the polling results that 46%, almost 47% thought that we are in a recession right now, only 3% of you are actually shifting into a true disaster recovery mode where you're trying to cope with the recession and be able to recover on from there. So great feedback. It's good to see there is a diversity going on there. So let's go ahead and we'll move on to our next set of questions. Not questions, excuse me, our next topic. The next topic I wanted to cover, because it's been the hot topic, is inflation. And I think the first thing that I always want to clarify with people is we have to understand the difference between high inflation and high prices, because the Federal Reserve's mandate is to have stable inflation. And inflation is the measure from one time period to another of how much did prices change up or down. High prices is the effects of what happened with that inflation. So what I keep warning people is, look, the Federal Reserve may get the inflation rate back down to 2% where they want it, but that doesn't guarantee that we're going to have prices back down to where they were before the pandemic crisis when we had 2% inflation. We've got factors going on, especially in the energy complex, that I think that we may be seeing the U.S. once inflation gets back to the range it's supposed to be, we may still have $5, maybe even $6 a gallon gas. And the major reason for that is that the U.S. and Europe made this commitment, after our last elections to go green. And so the problem with that strategy is, even though long-term, I think most people would probably, clearly embrace that, we don't have the infrastructure built for green right now. And so I think because we've given this message to the fossil fuel industry that you're the bad guys, you're polluting, you're hurting the environment, they've gotten that message loud and clear. Investors are reluctant to invest in those fossil fuel energy companies. Banks are reluctant to lend to them now because the regulators have threatened to impose higher capital requirements to deal with the potential legal risk of being sued for supporting somebody that caused major economic damage. And so we've got a situation there is that because the fossil fuel industry has now rotated their focus, especially the major companies are looking for how they get involved in the green types of services, that I think that we could see, especially the energy side, with prices higher even though inflation isn't stable. Because like I've told my staff over and over again, you can have $6 a gallon gas today, you can have $6 a gallon gas next year, that's 0% inflation. The Federal Reserve says mission accomplished, inflation is stable, and the consumer saying, well, wait a minute, it's still $6, or groceries are still elevated, those types of things. So I think that, especially with a lot of the geopolitical things, with the conflict in Russia and Ukraine, OPEC and what they're doing, things like that, I think we need to be prepared for the reality is that as the Federal Reserve and as the consumer themselves bring inflation under control, that may not necessarily mean prices come down. And in order to get prices to come down, that may actually, what it really takes for prices to come down is the consumer. They need to dramatically, or they need to at least, cut back on spending. I don't know if it's necessarily dramatically, but they need to cut back on spending because the old dynamics are still in play. Is that if consumers say, I'm not buying as much because prices are too expensive, pretty soon businesses have excess inventory. Then you start seeing discounts. I just saw a couple articles earlier this week where retailers were saying that they are fearing that for the holiday shopping season, they're going to have to offer discounts to get their goods sold. And so I think that's the thing I'm going to always tell you is the Federal Reserve's mandate is not to bring prices down, it's to bring inflation down. And that's what we need to keep an eye on because that'll affect when the Federal Reserve decides to stop raising interest rates. Let's look at from the construction side because that's been a hot topic because the construction industry or the whole, construction, whether it's commercial or residential, is definitely feeling the effects of higher interest rates, but they've also felt the heavy effects of the inflation and the high prices. So I'll start with the good news is that we can see that lumber prices have been declining. They peaked back in, it's about April or May, and they've been steadily coming down. And so a lot of people are saying, well, I keep reading lumber prices down dramatically. How come we haven't seen the cost for construction come down? These are people who are not in the construction industry. Because what I try and say is, well, you got to consider the other components. And I'm not going through all of them, but some of the major ones, I say, look, drywall, gypsum hasn't come down in the least. It's still going up. And that's a major component for construction. And then look at cement prices. Same story, not coming down, still going up. So I think that that's one of the things I say. And then I say, of course, a major component that's been a big challenge for the construction industry is wages. Because of these labor shortages, having to pay more to attract employees and keep them, we've definitely seen, even though wages aren't part of an inflation calculation, for a business, they certainly are. It's part of their expense calculation, and wages have not peaked in the construction industry, at least on a national basis. So that's where I say that we are still seeing, for the construction industry, evidence that inflation still has the ways to go to come down. First, it needs to stop rising and start coming down. But for the U.S. as a whole, we're seeing a few more signs that inflation may have at least peaked. but that doesn't mean a dramatic decline. So I think that's something we just need to consider as you're planning for next year. So we come to the favorite topic for a lot of people, what in the world is going on with interest rates? And I think what I keep telling people is, let's think about what lies ahead. The Federal Reserve started raising interest rates this year. They've raised interest rates essentially 3.25%, or what the industry calls 325 basis points. Every basis point is 0.1%, so 100 basis points is 1%. But they've raised rates from 0.25% to 3.5%, with the intended goal of killing the growth of inflation and getting inflation to come back down again. I'm going to tell you that I think, people say, well, are they done? When are they going to finish? And I keep saying, listen to what the Federal Reserve is saying, because they've been pretty clear. They're not being obtuse in their communications. They're being pretty clear, and they're basically saying they are going to continue to raise that overnight borrowing rate until they see clear progress on inflation. And the concern for me is the second part of the sentence that the media doesn't play as much. They say, even if it means economic pain. And I would simply tell you from Fed speak, that is the equivalent of them saying, even if it means the economy has to enter recession. That is my interpretation. That's the warning I think that they've given us. And so I think that, the Fed, there's been an old saying for the Federal Reserve in their interest rate policies that they will raise interest rates until something breaks. And the Federal Reserve hopes that what they're going to break is inflation and have it coming back down again. The real risk could be they break the economy and we enter to recession before we actually get a true progress on the inflation side there. So I think we need to understand that. Wanted to give you a little bit of perspective on Federal Reserve interest rate increase processes. Once the Fed raises rates, what's the average of how much do they raise the rates? So I've gone back and looked since 1972. So that involved what I'd call several traditional recessions, where it's basically a inventory, supply and demand problem versus crisis recessions like the financial crisis and the pandemic crisis and the big inflation period of the early 80s. And when I look at all of those since March of 72, including all of those scenarios, the average increase in the overnight borrowing rate, what they call the Fed funds rate, 512 basis points, or 5.12 percentage points. The worst one that we saw was during the last severe inflation problem of the late 70s and early 80s, where the Federal Reserve actually started raising rates in December of 2006, and they continued raising rates until March of 2080. So if you think this has been painful or long, that's how long they were raising rates, and they took rates from 4.75% to 20%. I'm going to again say I'm hoping and believing that's the outlier, that we're not going to have to repeat that scenario this time around. But if I just took the average for all of it since 1972, 512 basis points, well, if you figure we started at 0.25%, 512 basis points gets us basically up to 5.375. We're at 3.5 right now. The Fed has indicated they're targeting right now 4.5%, but I think we have to understand the risk could be as much as 5%. If I pull out the big inflationary period of the early 1980s where we had those massive rate increases, the average is 375 basis points. So again, 375 plus 0.25% would get you to 4%. Well, we're almost there for that. And the Fed's been pretty clear, 4% is not where they plan to stop. That they're thinking they have to raise so they at least get to 4.5% and maybe 5%. But they're trying to do it very rapidly. This is the fastest in history, the steepness of the increases, where they're doing these 75 basis points at a time. The only other time where you've seen anything like that, which is such an anomaly, was during that huge inflationary period where we were averaging 13, 14% inflation, and Paul Volcker came on as the Federal Reserve Chairman, and he had a couple of meetings where he raised rates by 3 percentage points at a time just to get them so that they really started to impact the economy and everything else. And there was a case where the Federal Reserve clearly made the decision, we have to put the economy into recession to kill inflation. That's not as clear-cut this time around, but that's the perspective I want to give you. So that means that if you're looking at your operating lines where you're tied to like the prime lending rate plus some type of a spread, well, the Fed funds go to 4.5%, prime's going to 7.5%, and then whatever your spread is above that, that's what you should plan for over the next 12 months. I think that this is a case, again, we need to understand The Federal Reserve seems pretty clear in all of their messaging that inflation is their priority, even if it means recession. So let's keep that in mind. I think that what I want to show you here, to give you some perspective, short-term borrowing costs have not risen as much, maybe more steeply, but not as much as we've seen from previous cycles. So the red line is the prime lending rate, and the blue line is the 3-month U.S. Treasury bill rate. But you can see that we were flat for so long there from the, after the financial crisis. It rose a little bit from 2015 through 2018 and then dropped again, flat again until this year, and now a much faster rate of increase. But we're nowhere close to the levels, at least, that we were back in previous cycles. So just to give you a little bit of perspective. And then the other thing I want to show you is for term financing. We've definitely seen a clear rise, if you look at this, from the start of the year. We're really from June of 2007, June of this year, 2022. We had this real steep rise in long-term rates, 10-year Treasury rates. And now what we've seen is they've come off the highs, and now they're bouncing around in this range. So if you have term financing tied towards like the 10-year Treasury rate, I think what you're going to be looking at, I think the 10-year Treasury is going to bounce between 3.5% to 4.5%. And as such, that's kind of where you figure is that if you have 10-year Treasury down towards 3.5%, you're looking at a project, you're looking for term financing, that would be a level that I would say you should probably be paying close attention to going ahead and executing on your plan. If you get up towards 4.5%, unless something has radically changed with the inflation picture, I think that's a case, again, where you get these overreactions from the markets over short time periods that settle back down again. But I don't think that we're on a continued rising path for long-term rates, because long-term investors are more like, for those of you that are hockey fans, I've always said they behave like Wayne Gretzky, one of the hockey greats, where his advice was always, you need to skate to where the puck is going to be, not where it is right now. So as soon as the Federal Reserve started communicating really clearly in June that they were getting more aggressive because they had to get inflation under control, long-term rates spiked up in advance of that, figuring, oh my gosh, that means that 10-year rates are going to be at this level. Compared to short-term rates, they wait until the Fed actually raises rates. So I think that's why I think that for term rates, they're going to vary in a range, but I think most of that increase has happened because they did it in advance of the actual event occurring there. One of the myths I try and knock back too, because people are saying, oh, rates going up, nobody's lending anymore, the banks are all going to get defensive. I'm going to say that may be true on an individual basis, depending on the bank and what their business model is. But this is the data from the Federal Reserve, and what it's showing you is that the blue line is C&I loans, commercial and industrial. So that's your traditional, like your operating lines, things like that. You can see the big drop-off out of the pandemic, and then it's been steadily rising since the end of 2021. That big drop-off, I would make the argument to you without having hard evidence. I think the reason in talking to our corporate lenders why that dropped off was from PPP funds, that businesses had plenty of money then when they got their PPP funds forgiven, so they didn't need to borrow. And now as their sales have grown and the business is growing, now they're still borrowing. So you can see loan volume is rising both for the blue line, which is commercial and industrial, and for the red line, which is commercial real estate lending. Banks are still lending on commercial real estate. And so if your bank isn't, that may mean that you need to be checking with somebody else. But banks as a whole, their terms may have changed, or their lending standards. What I have told people over and over again in this rising rate environment, fundamentals matter. Poorly run companies were able to get financing when interest rates were so low. Now that interest rates are rising, banks aren't desperate for something that's generating revenue for them, so they may have tighter standards. And so for the weaker companies, their spread against whatever it is, whether it's prime or whether the 10-year Treasury, may be widening and getting more expensive. But the well-run companies, I think their spreads hold pretty firm because they're still a high-quality credit risk to be able to lend to. So I just wanted to kind of kill that myth, because I've heard that being said from some sources, some places saying, man, banks aren't lending anymore, and it's just not true. Banks, financial institutions as a whole, as long as they're sticking to their credit standards, are more than willing to lend. They're just not willing to look at, these low cap rates we had on commercial real estate. I think, those are basically going to be a thing of the past now. Now it comes back to fundamentals. But under the right terms and conditions, there's still lending available. So let's go to our third question. And this question is asking you, given what I just gave you for information, where do you think term financing costs will be 1 year from now? So I think that's, I'll leave that to you. Amy, let's jump back to the questions we've got out there, and I'll continue to answer those as we're going through the polling question.
All right, so one of them is, do you think the Federal Reserve is taking the right course of action with their interest policy?
I think overall the Federal Reserve is pursuing the right course of action. My criticism of the Federal Reserve is I'm going to say, a day late, a dollar short. They should have stopped buying U.S. government securities once the pandemic crisis had stabilized, and by May or June of 2020. They should have stopped buying government securities and suppressing interest rates. They should have let the free market determine where interest rates would be at that point in time, and then they should have started raising interest rates. I would argue they should have started raising interest rates about June of 2021 after that last big stimulus bill went through. Instead, they waited all the way till this year where inflation had caught hold, gained momentum. So now they're scrambling to catch up, but I still think they're following the right strategy. They're just having to be much more aggressive in this strategy now than they could have been if they would have been more proactive on it.
All right. There is a couple that I can combine. Is single-family housing growth, and then also have 30-year mortgages dropped off?
So I'll answer that backwards. 30-year mortgages have not really dropped off that much. Just looking at the last one from bankrate.com, we've still got 30-year mortgage rates being quoted pretty close to 7%. So they're not rising, but they're not coming down either. I think single-family residential housing, we've clearly seen a huge drop-off in both sales, but also in construction because of the challenges for the construction industry with high raw material costs, high labor shortage issues with wages. But fundamentally, I'm still positive on the outlook for residential housing because we have a fundamental supply and demand issue. We have a generation that's the biggest generation in history now, the millennials. Essentially what we've learned is that their life cycle was 10 years delayed compared to the baby boomers, which we were trying to use as our model for them. So they weren't getting married unless they were getting married in their early to mid 30s, having kids in their mid to late 30s. So now they're of the age that they want houses, and there simply are not enough houses in the U.S. for the demand that's out there. So this isn't a speculative bubble or anything like that. This is more the case that there is fundamental supply and demand. What we're doing right now is correcting for the problem that the Federal Reserve created by suppressing interest rates through their purchase of U.S. government securities, including mortgage-backed securities. They suppressed those mortgage rates where we had mortgage rates at 2.5% to 3%, where they probably should have been more like 4 to 5%. And so now mortgage rates have accelerated up to the 7% level. We're unwinding some of that, and home prices need to come back down to the more fundamental level of where they should be. But I'm still long-term positive on single-family housing because it's a fundamental need for that. It's just a matter of convincing neighborhoods, governments, and everybody else of the need and supporting that type of growth rather than fighting it whenever it comes along. Let's do one more question, and then we can. Yeah, let's take one more, and then we'll hit this answer to the poll, and then we'll catch the rest of them at the end.
This is an interesting one. Could we have an inflationary depression?
That depression, okay, that's a pretty extreme. But the answer is yes. I think I'm going to say you could have a inflationary recession. That is what is known as stagflation. You've got high prices, you've got rising prices, and yet you've got falling growth, partly because of those rising prices. It ultimately unwinds itself. So I'm going to say, depression is basically a severe recession. So maybe at the start of a depression, you could have that situation. But I think because, again, a depression means economic growth has dropped so severely and so quickly that would kill any future inflationary growth. So I don't think you could have sustained high inflation with a depression. I think that you could have, for a longer period of time, rising inflation still while you're in a recession until it cumulatively piles up to drop off demand enough to kill it off. And we did see that in some previous recessions, where when the recession started, inflation was still on the rise, but as the recession progressed, then the inflation dropped off. So let's go ahead and go on to the remaining topics I have for you, and then I'll take the rest of your questions. First, let's look at the polling. I guess I ought to do that. The feeling is pretty strongly that we're going to see higher term financing costs 1 year from now compared to where we stand right now. So I think that'll be interesting to see. What I always caution people is, one of the things you always have to be careful of, something they talk about in economics, economic theory, but it's also real life, is what they call recency bias. When somebody asks you what's going to happen, you base your thoughts on what's recently happened. We've had these rising interest rates for all year long, so there's a tendency to get the mindset that interest rates are going to continue to rise even further. What I would say is this is a bit in conflict, since we had 46 or almost 47% of you think that we're in a recession now. I would make the case to you that if we're truly in a recession, it's going to be hard to sustain interest rate increases. I think, once again, that would imply interest rates coming down. And I'll talk about that more as I'm giving you my own outlook for the economy. But I would just challenge everybody. My own inclinations is I think that we will see rates probably near, in the same range, but I don't see any dramatic or any real increase in rates from where we stand right now, unless something like a geopolitical problem or something like that pops up. So I just caution always is that be careful about basing your thoughts on, well, this is what's going on, so this is going to continue to go on, because that's usually the point where tremendous opportunity comes about, because everybody thinks, oh man, the stock markets are going to fall forever. Oh man, interest rates are going to go up forever. And then we discover that was probably where the peak occurred and would have been the perfect opportunity to look for things coming along there. But let's go ahead and go along, and I'll show you why I think that we probably won't have term financing. Short term, yes, the Fed still has a ways to go to get to 4.5%, but I still think that 10-year will be in a range. So are we heading for a recession? And I'm going to give you the spoiler right up front, and then I'll give you my explanation. I think that we will be in a recession somewhere between now and the end of next year. I think the Federal Reserve has made this conscious decision, even though they'll never publicly state it, that they need to create higher unemployment, have more people available to work, to give businesses back at least an even playing field when it comes to wages, to prevent a wage price spiral from developing like we had back in the late 70s and 80s. And I think that they believe, whether correct or not, that they know how to handle a recession now that they've got rates up in the 4% range, that let's put the economy into recession, that'll help break the back of inflation, and with wages, give employers more bargaining power, and then they'll deal with the recession by cutting interest rates and things like that. So let me give you my reasoning why, because you're going, gee, thanks a lot, you really made my day. Here's one of the things I look at. This is from a firm called Bridgewater Analytics. I track very similar things, not as many. I'm getting the same type of answer. Basically, as you see, if you look over to the right-hand side, June of 2022, it was green because there was only 2 items that were flashing recession warnings and only 4 items flashing cautionary warnings. We progressed to July. We added 3 more that went into the red because now we had, or 2 more because now we had 4 in the red, and we only had 5 that were in the green. And by August 31st, now we've got 6 items in the red flashing, hey, there's going to be a recession within the next 12 months. And we've only now got 5 items that are saying we're still green. So I think when I look at some of the other things as well, I would draw the same conclusion. I think the Federal Reserve is pushing the consumer to their limits. The consumer is going to basically run out of their savings. They'll have maxed out their credit cards. And one of the real sad things that they're learning now is that many people didn't understand that the credit card rates are tied to the overnight borrowing rate or to our short-term borrowing rate. They thought with a 15 or 16% interest rate on their credit card, that meant it was a long-term rate. So they're seeing their minimum payments now growing just because of the interest expense as those rates are going up. And so I think that consumers that were using the credit cards or a bridge now are having more of their paycheck getting absorbed by just making the interest payments and not even being able to pay down their balances to any degree at all. So I think that the Fed is going to break the consumer, and that's what's going to cause the recession. But let's look at a few more things just to show you why I think that. Nope, I take that back. It was just, I gave you those 12. I didn't want to spend forever on that. But that was the snapshot picture. And that's my message is, yes, I think we are on the course to a recession if the Federal Reserve continues on, especially if they raise rates 0.75% in November and then another 0.75% in December. I think that will finally be the straw that broke the camel's back. And I think that what I keep telling people is, even though I think we're going to be in a recession by the end of next year, I don't think that it's imminent. You know, it's not going to be like by the end of this year. So I think you still have time to prepare. And so that's why I just want to kind of walk through, because people always say, so what am I supposed to do to prepare for a recession? And I've always just used the environmental analogy. And my answer is, prepare for a recession like you would a hurricane. You know, if you know it's coming, you know, you start boarding up windows, things like that in advance. You don't wait for it to get there. And I would say the same for a recession is, I've always advocated for people and businesses that you should have an economic disaster recovery plan, just like you have an environmental disaster recovery plan, so that if you have an earthquake or a flood or something like that, you can pull out your manual, you'll be objective, you follow the steps, and you get your business back up and running as a result. If you do the same thing for recessions, because they're natural recurring economic part of the economic cycle, I think that now's the time you dust off those plans, you make sure they're current, and that will vary by business. But what I really say, one of the things that I say, now's the time to do it is, you know, first think back to the financial crisis and the pandemic crisis, and how did that affect you? What got hit the hardest? Where could you shore up or do something there? But one of the areas that we definitely saw, especially for the financial crisis, was that lending dried up then. You know, you couldn't get a new loan or a line of credit when you needed it if you didn't already have it in place. So what I've just said is that, and I keep it broad, so nobody's accusing me of doing a sales pitch for Washington Trust Bank, but I've said that it's critical that now's the time you ensure you actually have a solid working relationship with your banker, and that you're not what they would call a transactional client, somebody who's constantly shopping rates for the lowest borrowing rate and the highest deposit rate with no loyalty to a financial institution, because those are the people that had the spigot turned off for them when the financial crisis hit. They were the ones who had trouble getting PPP loans because they didn't have a relationship. So what I would say is, I just simply say from a general standpoint, remember the financial institutions that were there for you during the financial crisis, that were there for you during the PPP crisis, and actually were willing to help you get your PPP funding. And you should probably be having a discussion with them about, you know, how can I set up a line of credit? What's your terms and conditions? What's, you know, the metrics I have to maintain so that that line of credit, you know, still remains available. For others of you, maybe you don't want having to take on debt or anything. Well, then how much do you need to build up in reserves for cash? Is it 6 months worth of earnings? Is it a year's worth? But now's the time to be thinking about that, strategizing on that, and starting to put that game plan together. Because I just say over and over again, you don't want to be reacting to a recession when it hits. You want to be prepared and ready to move when you see it happening, because a recession is going to be very similar to a hurricane. You will get the leading edge of the storm, and that may be what some of you are experiencing now, is that leading edge where you feel that, you know, you're already in a recession. But that's really what you need to do, is that planning ahead of time. I can't give you a magical answer, because for each business or individual, it's going to be different there. But now's the time. And I think that's really where I want to leave it to you. I'm not trying to depress you or anything. I think we have time to plan for this. I will say over and over again, like I've said before, for those of you who heard me speak, out of crisis comes opportunity. And I still see so far the signs for this recession is more of a traditional inventory, supply and demand recession, not a crisis recession. We don't see problems in the financial systems. We're not seeing problems elsewhere that would be a crisis situation. So I think that that's where advanced preparation will help you be one of those people who can take advantage of those opportunities, because I guarantee they'll come up. So let me stop there. That'll still give us about 10 minutes for the remaining questions. So why don't we, Amy, just go down what you have, and any that I don't answer, I'd be happy if Mas Adams just submitted those questions to me, and I'll respond back with an email response that you can distribute out to your audience.
All right, sounds good. So I can pull a few of these. Can you explain why you think wage growth is in a recession?
I don't think wage growth is in a recession. I think that wage growth is one of the reasons why the Federal Reserve is going to put the economy into a recession. What the Fed is fearing is the late 1970s, early 1980s. It's a different situation then. A lot more jobs had cost of living increases automatically adjusting for inflation. And so, consumers weren't slowing their spending as inflation was going up, and they would demand, they get higher wage increases, which meant they could afford more to spend. So I think the Federal Reserve just does not want that to happen. And they know that we're coming up on a new year where many businesses, they do their salary reviews and they give their raises at the beginning of the year. So I think the Federal Reserve's real goal, without them ever specifically saying that to you, is that we need to create unemployment. I think that probably means unemployment in the 5 to 6% range where there's excess employees now looking for work. We eliminate those job openings where we've got this situation right now where there's 1.7 jobs for every person unemployed. That's where they're worried that would create this, continued wage increases. So I think that they've decided we got to create a recession. That'll stop the wage price spiral from starting, and then businesses have a chance to be on equal footing with the employee of establishing a reasonable wage.
All right. Are you expecting significant stock market declines, or do you believe much of the recession has already been factored into the current values?
For traditional recessions, and I never say that history is going to repeat itself, but without the financial, with the crisis type of recessions, a stock market usually drops about 30%. And we've seen, the S&P, we've seen the NASDAQ fall even more, but the S&P is down, depending on the day, it's down between 20 to 25%. So I think that the stock market has priced in most of what they believe for a traditional recession. I think what we haven't fully done, and that may happen as we go along here in the next month, is seeing what corporate, we're going to have corporate earnings season that started this week. What is management saying about the future? And if they hear really defensive stuff from management, then you may see one last process, which is the adjustment down by analysts of corporate earnings expectations. But again, because I think long-term interest rates have now fallen into a range, that's a big part of stock valuation. If you're using, discounting all the future cash flows to today's dollars, as interest rates are going up, all else being equal, the price of the value of that company should go down. And I think that is what has happened. So I think I'm not going to say we're there, but I think we're a good ways there. And I think that what I would tell you is through the end of the year and probably into the first half of the next year, expect continued volatility. I'm not making any case that we're going to see a massive rally out of the market, but I think that I'm not calling for a 50% decline because I just don't see the conditions for a crisis type of recession.
All right, thank you.
One thing I'll throw in real real quick. Okay, and I'll answer just something. I'll just give you an insight real quick because I know it's something that I've been talking recession. On average, normally for a normal recession, you should plan for 9 to 12 months for a recession. I don't have any crystal ball, but I would tell you when people ask me that, I said, it's not going to be 3 or 4 months. It's not going to be 2 months. It's going to be more of a traditional recession, which is about 11 months is the average. I'm sorry, go ahead, Amy.
Oh, no problem. So I'm going to combine a couple of questions that have to do with labor shortages. So is it good for the economy that we are creating all of these new jobs when it seems all industries are complaining of not being able to fill jobs? And where have all the workers gone?
Well, I always give the answer, and most of the Moss Adams people who've listened to me before have heard me say this. If I knew the answer to the last part of that question, I wouldn't be working for Washington Trust Bank. I'd be an independently wealthy consultant or something. But I think what we have to keep in perspective for jobs creation, because I keep saying, look, it's great the way the headlines play it up, and yes, we are creating jobs, but we have to remember we're talking jobs, we're not talking people. And what we have seen is an increase in the amount of people holding down multiple jobs, and we've also seen an increase in part-time jobs. So I'm going to argue that the quality of jobs aren't necessarily, what we would ultimately want. You want full-time jobs, well-paying jobs, but I still say jobs still create income, so that is still an overall benefit. But I think that, the whole job situation of where have all the workers gone? Well, we do know, at least from one Federal Reserve study, they say that 1.5 million people retired early because their 401k and their house value had gone up so much that they recalculated and said, hey, I can retire early. I'm going to be a bit of a cynic, and I'm going to say those people were relying on an investment portfolio. If it has gone up so much, that isn't generating steady income. It was generating growth. Well, guess what? That portfolio is now down 20, 25%, or maybe worse. And they've also didn't budget for the expense level they've seen now. So I'm going to make, or at least posit the idea that many of those people may be coming back to the labor force within the next year or so. The other thing that we see is that we've seen a big increase in people becoming self-employed, saying I can start my own business. And every person who becomes self-employed is one person less that's available to businesses to hire. And we know the track record for self-employed. Some of the studies I've seen is, within 3 years, 75% of those businesses have gone out of business. So I would make another case there as saying all of the unavailable workers, because they decided they're going to be self-employed, may be coming back to the workforce over the next 2 to 3 years. I can't give you an answer on the millennial generation because they're not an early retiree. Maybe they're all still living with their parents. I would be shocked if the parents would continue to allow that. But there is something of a mystery there of what's going on. And we also have to remember, I've seen two different studies one from Harvard Medical, the other from Stanford Medical, that estimate in their analysis that we still have between 1 to 3 million people disabled because of long COVID, unable to come back to the workforce at this point in time. And the unanswered question is, does that play out? They're able to come back, or are they going to be permanently disabled? So it's a huge challenge, and I think that's why the Federal Reserve wants to, create unemployment to at least generate bodies available for work because they became unemployed. Let me give the portfolio question. I see that coming through. We better cover that before time runs out because people are going to be upset that they didn't get a chance to get their 3 quarters. So let's hit that one. Okay, now that I've given you all that information, you know what's going on with your own real world. What I would like to know from you is what's your biggest obstacle to growth for either your business or the clients that you service? Is it labor shortages, rising wages and prices, government red tape, taxes, or other? This is basically the same question the National Federation of Independent Business asks their small businesses every month. So I'm just curious to see what matches up against what they're seeing from their national surveys. While we're waiting for that, I think we still have about 3 minutes. Why don't you go ahead and throw at least one more question at me? And then, like I said, I'm more than happy to have you send all the others that didn't get answered. I love that we've got so many questions, and I'd be happy to answer those separately.
All right. Can you share your thoughts on how long you feel the recession may last with the inventory, supply, and demand recession?
That would be where I think the average has been 11 months. So I'm going to tell you, I think between 9 to 12 months if it's a traditional inventory type of recession.
All right, that was a quick one, and it looks like responded. So I'm going to pull up the results here.
Okay. Rising wages and prices. Almost 40% of you have that as your primary problem, with labor shortages being the second biggest one. So I think that's pretty consistent with what we see from the National Federation of Independent Business. Inflation, which is more of a catch-all for high prices, but a big component is wages and prices, is the #1 issue for small business, with lack of qualified help, labor shortages being #2. So all of you are very similar to what we're seeing from the overall national polls as well. And those are things that the Fed is trying to tackle, both of those, through rising interest rates. Whether they're successful, we'll have to wait and see. So let's go ahead and take one last question, and then I'll wrap it up so we stay on time.
All right, let's see here. How about this one? Can financing events in other Western economies provide insight into where the United States is heading? For example, does the recent trouble in the British bond market spell any trouble for USA?
I think it spells trouble only in the ripple effects of what goes on there, because what we've actually seen is that with all of the confusion going on in the UK, those rising bond yields for for the British government bonds have actually created higher demand for US government bonds as a safety places, to park your money for safety. So I think that what I would say is that we should definitely pay attention for potential problems, especially in Europe, because they're going to go into recession before us because of their high dependency on Russian energy, and see whether there's anything that pops up that may make it a bigger problem than what we've anticipated. And, their financial system is different than the U.S. They don't have any form of insurance on deposits like the FDIC, and their banks really are joined at the hip with their government. So a lot of the lending is in support of government policies and things like that. So they had a far worse financial crisis, with Italy, Greece, Portugal, Spain, and Cyprus all on the verge of collapse, where, we had banks on the verge of collapse, but we didn't have states on the verge of collapse. So I think we should observe those, and especially I would say observe them for unexpected bad things happening, because then we could look and say, now are we seeing anything like that happening in the U.S.? So I want to thank everybody for joining us. I'm 1 minute over, but I think close enough for all of you. I always appreciate talking with this audience. I'll look forward to, I hear rumors, hope, although like I said, hope's not a strategy, but I've heard rumors, and I hope that maybe next year might be a combination of live and virtual, because I love to be able to actually interact people in audiences as well. So I hope the information I've given you gives you something to think about, helps you for planning, but it certainly shouldn't cause you to crawl under your desk and create a self-fulfilling prophecy, because if everybody starts behaving like we're already in a recession, guess what? We will be in short order, because people stop doing the business they're supposed to do. So as I said, I think the inflation is down the horizon into probably the second half of next year, and once it hits 9 to 12 months past that period. So use that as your general game plan and set your strategies now. Amy, thank you very much for all the time. I'll turn it back to you.
Right, Steve, and thank you for a very informative presentation. We always appreciate your insights. And thank you to our audience for being engaged and submitting all of your questions to help guide today's conversation. And we hope you enjoyed today's presentation. Our next session for the Building Opportunity Conference is next Wednesday, October 19th. There is a link in your console to check out that as well. And if you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 2 weeks should you have difficulty downloading it now. And finally, here is a link to an online survey for today's presentation. And thank you for joining us. We hope you'll join us again next time. Take care. Thank you, Steve.
Thank you.